Welcome to lesson 2, the actual pre-approval process. So in this lesson, we're going to go over what to expect. So you've called a lender and what's going to happen? What's it going to be like? What are they going to ask you for? We touched upon it in lesson 1. The very first thing to expect is that they're going to ask you questions. So as we talked about in lesson 1, be prepared to answer questions about income, dates of employment, how much you make per hour, or if you're on a salary, how much you make on a salary. So they'll lead you through a certain number of questions. I like to call this the intro call. It's like a discovery call, getting to know you. So I definitely suggest that you call a lender first before you apply on any online portal, etc., in order to just let them ask you some questions and give you their knowledge about how they're going to lead you through the process. That goes to that comfort level that we mentioned in lesson 1. So pre-approval versus pre-qualification is the first point that I'd love to go over. This is actually very misunderstood in our industry, so I'm going to clear it up here. A pre-qualification is a verbal talk with a lender, or it could be online, and they've pulled your credit. That's it. It means that they've checked your info out on paper and they've pulled your credit, verified that you have an appropriate credit score, but nothing else. They've seen no documentation and they've seen really nothing else. Nothing else has been checked out. An underwriter has not seen your profile. In the pre-qualification, when they pull your credit and haven't verified any documents, what this does is it can possibly set you up for questions later or concerns later once the documentation is reviewed. So I can remember in my history of closing thousands of loans, many instances where we had a conversation with a client and then we get their pay stubs, and the pay stubs might tell a little bit of a different story than what we understood on the phone. So things like number of hours, gaps of employment. We had a client one time that had gone out of the country to go visit family for a couple of months. So there was that period that they weren't paid. All of those questions go into very seriously on calculating what income is. Now, income is the number one driver, aside from credit, into qualifying. So pre-qualification is not looking at any of those documents. So if you're going to get a pre-qualification letter, it basically means there's definitely more work to be done, and you possibly are not ready to make an offer on a home for sale. So pre-approval is what you want to make sure that you're looking to obtain from a lender. What this means is that documents are going to be required. Pay stubs, bank statements, photo ID, photo government issued ID, and there's other documents depending on your situation that could be required. A great loan officer that you're talking to will lead you through this list of items needed very, very quickly in the process once you have that initial phone call. Pre-approval versus pre-qualification are two very different things. What documents are you going to need for pre-approval? So I like to ask people to remember the words 222. We basically need 2 of everything. 2 months bank statements, 2 years W-2 forms, or 2 years tax returns if you're self-employed, and 2 paychecks if you're paid every 2 weeks. We need 1 month of paychecks. So if you're paid 4 times a month, we would need 4 paychecks, but most people are in the 2 category. So that I designed the words 222 so it's easy to remember. Now, as I mentioned before, there will be possibly some other things that might be needed. Maybe a divorce decree, maybe bankruptcy papers, maybe a child support order, things that are outside of those basic income and savings documents could be required. So make sure that you discuss that with the loan officer early on during that loan application process. In the application process, as you're gathering these documents and preparing to submit them, It's important to also ask the loan officer what their preferred method of receiving documents are. So, what I mean by this is not everybody is tech savvy or wants to submit things online. You might prefer fax, you might prefer in person. So, it's really important that as you're narrowing down lenders and as you're making application with different lenders, that you're asking them what's your preferred method of receiving documents. I actually, when I did my own refinance loan actually several years ago with my bank, and they're a big bank, they only would require or only would receive documents on a secure portal. And I didn't like that portal very much. And I do this all the time. It wasn't very user friendly. I asked if there's any other way I could get them documents, and they said no. So it's important to ask who you're dealing with. Is there any other way that I can get you documents? I don't feel comfortable with this way. So that's also a way to help you narrow down who you're going to be dealing with in the very end during this process. So make sure you ask that question. You're probably wondering, what happens behind the scenes? I give my documents over, I have this talk on the phone with a loan officer. What really happens behind the scenes? That's a great question. So your loan officer, and they possibly have a team or they possibly have someone behind the scenes that's helping them, is going to look at all of the data and all of the documents that you provided. They're going to run numbers, they're going to do calculations and make sure that you fit within certain program guidelines. Now, a further lesson that we've got for you here in a little bit, we'll talk about programs, but behind the scenes, what they're doing is they're calculating, they're looking for accuracy, they're looking for threading things together about your background to make sure that they've asked you for all of the potential paperwork that they need in order to prove savings, income, maybe you have overtime, maybe you have child support, maybe you receive child support. All of these things go into the decision for a pre-approval, and they're all extremely important, and none of them can be overlooked. So that's what they're doing behind the scenes. Now, timeline is going to range from company to company. Certain companies turn at the same day. Other companies, you might be waiting 3, 4, 5, 7 days. I've heard clients tell me that they just waited too long. So that's another question that I suggest that you ask during this pre-approval process as we've been going along and revealing the process to you. Ask them, how long should I expect this is going to take? That's an excellent question, because if your timeline is more urgent and you need an answer super quickly, you need to know if they're able to deliver that. That will help you decide which lender you're going to give your business to later on. So after you've submitted documents, after all the behind the scenes and the lender is reviewing and asking and reviewing more and calculating, expect to have a more formal presentation of the terms that you qualify for, and that'll be the form of a pre-approval letter and should be mixed together with a summary of terms. So I'm going to pause here and just give you a word of caution. This is sometimes where borrowers don't really know what to expect, so they may not understand what to look for. If the lender is not explaining and being approachable to answer your questions or telling you what the next steps are, take this as a red flag. It might be a great time to get a second opinion to make sure that whatever concerns or questions that you have for your particular situation are being addressed. So I wanted to make sure and mention this very, very important point to make sure you feel extremely supported during this part of the process. Now we're going to go through some FAQs about the pre-approval process. The first one, how long is the approval good for? Great question. Normally, 90 days is an average time that a pre-approval letter will be good. That's because credit expires, pay stubs expire. So if you're going to be past the 3-month period, for example, you did it 6 to 12 months ahead, like I urged you to do when we talked a little bit earlier, that's okay that later on, you'll just have to update some documents. Reapplying or refreshing things with a lender down the road is not as much of a big exercise as you think. You might have to provide some new documents, might have to provide some new pay stubs, and they likely will need to re-pull your credit, but make sure that you talk about this with the mortgage professional that you've been dealing with. Another FAQ is the rate on my pre-approval letter the rate that I'm going to get? The answer to that is not necessarily. At the time of your pre-approval, the letter will have an interest rate on it. That is probably going to say on it as well, not locked. Locked means that it's not going anywhere, that it's locked in. That normally doesn't happen until later when you're under contract, ready to close at some point in the future. So at the pre-approval, they're going to put an interest rate on the letter that is the interest rate as of that time. So important to note, if you are 6 to 12 months out and you see on the news or you get correspondence, you might get correspondence from the lender that you're pre-approved with that interest rates have gone up or gone down, you might want to check in with them to make sure, how does that affect me? Does it increase my payment? Does it decrease my payment? Can I afford more of a house or less of a house, depending on what that interest rate is doing? But it's important to know that the rate on your letter is not going to be the final rate in which you're going to obtain when you do buy the house. Can I pre-approve with multiple lenders? The answer is yes. Any lenders that you pre-approve with, there should be no cost to obtain a pre-approval other than the cost of time to provide documents. And any lenders that you pre-approve with, any of those mortgage inquiries just count as one inquiry in a 30-day period. So not to worry, yes, you can definitely pre-approve with multiple lenders. Does my score go down after a credit pull? Not necessarily. The mortgage credit pull that will happen during pre-approval will not affect your credit for 45 days. So furthermore, any inquiries within a 30-day period just count as one. There's other things you might be doing on your credit that could affect your score, but the mortgage pull will likely not be one of them for a 45-day period. Is the credit pull a hard pull or a soft pull? That will depend on the lender. For example, the company that I work for, we used to only do a hard pull. And then recently, we actually made some changes to make sure that we were able to do soft pulls on credit. So it definitely does matter for the company. So make sure you ask the question in the initial interview process with that lender. Does the pre-approval cost money? It shouldn't cost money. There are some companies out there that will charge a credit report fee in order to recoup their cost. I would say if that were a lender that you were talking to, you definitely want to start looking elsewhere, because there's many lenders that will not charge you anything for the pre-approval process, especially ones that are referred by a trusted source like a friend, a coworker, etc. So make sure you ask the question, is there a charge for the pre-approval? Will my credit have to be pulled after 90 days? The lender is not going to automatically pull your credit after the 90 days. It depends how far after the 90 days you're re-engaging with them. I would say if a 6-month, 9-month, 12-month time has gone by, then yes, definitely expect that the credit will be re-pulled. Or if you're in a marginal area in your credit and you're on the borderline between one program and another, definitely they're probably going to re-pull the credit with your permission, of course. They can't re-pull the credit without your permission. After the 90 days, it won't automatically be re-pulled, but expect that at some point when you start re-engaging the lender, it probably will. This concludes lesson 2 of module 1. I'll see you in module number 2.